Good morning, everybody, and welcome to Tax Disclosures, What You Need to Know. I'm now going to hand over to Matt, who will begin the presentation. Thank you.
Good morning, everybody. Hello and welcome to what can only be described as an auspicious occasion as I come to you live from the offices here at ETC. For those of you who haven't met me before, my name is Matt. I am an Associate Director here at ETC and fairly new recruit. I've only been here for 6 weeks, and this is actually my first ever chance of presenting a webinar. So when I say auspicious occasion, that's exactly what I mean. First opportunity for me to talk to you guys. And today we're going to be talking about tax disclosures. First of all, I'd like to thank everybody for joining the webinar. Apologies for the original cancellation of this webinar that was due to take place 2 or 3 weeks ago. The gentleman who was due to present this unfortunately had a set of circumstances which meant he could no longer present. So you have the pleasure of joining myself, and I shall do my absolute best to deliver this webinar in a interesting way. So just a little about ETC. I'm sure you already know if you're on this webinar, we are a tax advisory boutique. We help individuals and other professional advisors with their complex tax matters. As you'll see in the tagline there, making the complex simple. That's very much our motto. Our intention is to support you guys and individuals with their complex tax matters. This webinar is designed to be a high-level overview. It's not designed to be overly technical. There are no legislative references for you to go and look up from this webinar. It really is an education process to, I guess, familiarize yourselves with the world of tax disclosures. So let's start then. Let's run through the contents page and see what we will be looking at today. So first and foremost, very straightforward. What is a disclosure? We should be looking at what is a disclosure. Next, why should a taxpayer correct their tax affairs? What might prompt a disclosure? Prompted versus unprompted disclosures, and we'll talk a little bit about what the differences of those are. What is a nudge letter? The different types of disclosure that you can make. Making a disclosure via the digital disclosure service. Increasing the chance of HMRC accepting a digital disclosure service disclosure. Penalties and interest, and then other types of disclosure that would be outside of the digital disclosure service. So first and foremost, what is a disclosure? Well, it is, I guess, what it sounds like. It's an opportunity for a taxpayer to disclose to HMRC or to take steps to correct their tax affairs if they are currently non-compliant. In general terms, it will involve reporting income or gains, which have not yet been subject to tax, when it should have been, or where too much relief has been applied against income or gains, which has resulted in an underpayment of tax. So why should a taxpayer correct their affairs? Well, I'm sure you are all aware it is ultimately a taxpayer's responsibility to ensure the correct amount of tax is paid on their income and gains. While obviously people employ professionals such as ourselves to advise them, HMRC's perspective and stance is always that it's the taxpayer's responsibility. So it's important that a taxpayer must always take steps to seek to correct their affairs. Making a disclosure actually assists the taxpayer in correcting their affairs and reducing their exposure to late payment interest and penalties, something which we will touch on later in this webinar. HMRC are also likely to be much more lenient towards a taxpayer who voluntarily discloses unpaid tax. So if you go to HMRC with your hands up and say, I'm sorry, I've forgotten about this, and given all the information that's needed, they are much likely to see you in a more positive light than if they were to send you a nudge letter. As mentioned, we're going to be looking at those a little bit later. So yes, always better for a taxpayer to go ahead and unpromptedly disclose. Failing to make a disclosure when one's required can lead to more severe penalties for being non-compliant, which I alluded to shortly before. And actually, the failure to correct a taxpayer's affairs could be an anti-money laundering offence. The offence being of knowingly avoiding tax, potentially leaning into the world of tax evasion, which then leads on to the benefiting from the proceeds of crime, which obviously, if you've always been, or if you have done your anti-money laundering training, which I'm sure you all have, you will know is a pretty bad place to be. No, apologies. For some reason, I can't seem to go to the next slide. Ah. Apologies, just bear with me one moment. Apologies, folks. Just bear with us for one moment. For whatever reason, the slides seem to be doing their own thing. Just bear with us one moment. Thanks. Hi, folks. Apologies for that. I'm not quite sure what happened there. We seem to be having some technical difficulties with moving the slides along. We are hopefully now in the right place, so we shall continue. So, what might prompt a disclosure? Well, we hope that in most cases, a client will come forward with information which has not been previously known to their advisor. Perhaps they've assumed that it wasn't relevant, or perhaps hadn't considered that it needed to be included within their tax return. And examples of that are things like rental income not being declared, overseas income, particularly when it comes to overseas assets held within a portfolio not being declared, and also the overseas disposal of assets not reported, particularly when overseas assets are already subject to tax at source. Secondly, an accountant or advisor may discover an omission from somebody's tax return when preparing their accounts. It may be that they haven't perhaps declared the dividends correctly, or that a benefit in kind has been provided to a director but hasn't yet been reported on a tax return. On the other side, there could be it could be a nudge letter from HMRC which will prompt a disclosure, or alternatively, an inquiry into a client's tax return itself might generate a disclosure. So, prompted versus unprompted. It sounds like what it is, really. A prompted disclosure occurs when HMRC initiates the contact with a taxpayer, necessitating the need for a taxpayer to make a disclosure, such as a nudge letter. In such cases, HMRC usually has identified that a liability is due and requests specific information from the client. This form of disclosure is often a result of HMRC's investigation or examination of your financial records supplied by a third party, and we'll move on to that shortly. An unprompted disclosure involves the taxpayer taking the initiative and approaching HMRC to voluntarily declare any unpaid taxes or discrepancies in their financial affairs. Taking this approach demonstrates a commitment to complying with the tax legislation and rectifying any unintentional oversights. So as I mentioned earlier, the putting your hands up and saying, "I'm sorry, HMRC, I've forgotten to declare this income. I'm now going to make a disclosure to do so. Is a much better position to be, as opposed to HMRC sending you a nudge. Opting for an unprompted disclosure significantly reduces the likelihood of facing any criminal charges or severe penalties. HMRC generally views unprompted disclosures more favourably, appreciating the responsible behaviour from the taxpayer who take corrective actions without external prompting. So we're going to have a quick look at what a nudge letter is. Now, if you have clients, I'm sure you will maybe have seen one of these before. There is an example of it in a later slide, but a nudge letter is what it sounds like. It's a nudge from HMRC to a taxpayer, giving them the opportunity to correct their affairs. HMRC often have the information already, but are encouraging the taxpayer to correct their affairs as opposed to opening an inquiry. So HMRC, as mentioned, would focus generally on one particular area, and it is not the same as a full inquiry. A nudge letter would usually be generated automatically from the system once HMRC have got some information that they want to know more about. A nudge letter does, despite not being a full inquiry, it does require immediate action, as failing to correct one's tax affairs or respond to the nudge letter can often result in an investigation. Common areas which we've seen nudge letters being issued are undeclared income from land and property, so rental income being received, undeclared capital gains on the sale of land and property. And these bits of information generally are available to HMRC through the land registry. Undeclared income or gains from overseas assets. As mentioned before, there is the HMRC will receive some information in relation to an overseas asset and would therefore send you a nudge letter to see if there's any UK tax requirement in relation to those assets. Undeclared income or gains from cryptocurrency. This is one that we're seeing an awful lot more recently, particularly with the way that cryptocurrency has gone in the past 2 to 3 years, with a very large boom in the 2020 and 21 years, and then a subsequent fall since then. Lots of exchanges such as Binance or Coinbase are sharing information now with HMRC, which is making their job an awful lot easier and resulting in people, those who use those types of exchanges, getting a nudge letter from HMRC to see if there's anything that they need to declare. In addition to those four, which I would say are the main four, on occasions we're seeing some nudge letters in relation to the furlough CJRS scheme or the self-employed income support scheme, and also those who are not being compliant with making tax digital for VAT. So hopefully you'll be able to see on your screens. It's a little bit small on my screen. Hopefully you can see there is an example of a nudge letter from HMRC on the screen. To the left side is a covering letter, which usually comes in the format of essentially, do you need to tell us something? HMRC won't identify in their nudge letter exactly what it is that they've got, because they're expecting you to respond and be fully compliant in your response. And to the right-hand side is a certificate that you or the taxpayer has to complete when they receive a nudge letter. The options are that they need to disclose through a digital disclosure service disclosure, that they do not need to make any disclosure because their affairs are up to date, and a couple of others relating to tax being deducted at source. That needs to be signed and returned to HMRC within the time frame given in the nudge letter. So different types of disclosure. We've got the Worldwide Disclosure Facility disclosure, the Let Property Campaign disclosure. You could also make a disclosure by correcting your earlier year's tax returns where applicable. And on the odd occasion, a simple letter to HMRC would also work as a disclosure. Just a note at the bottom there that the Worldwide Disclosure Facility and Let Property Campaign used to be separate disclosing tools, but are now dealt with under one umbrella known as HMRC's Digital Disclosure Service. So if you're required to make a disclosure, there are 3 stages that need to be followed. At first, once you've established that an underpayment of tax has occurred, you'll need to notify HMRC that you intend to make a disclosure. Now, that may well be, if it's a prompted disclosure and you've already returned your form, you still need to register with the Digital Disclosure Service. It's an online registration and requires the taxpayers basic information about who they are, who you are, operating as their agent. And once you submit the intention to disclose, you've got about 15 days to wait for HMRC to issue their Digital Disclosure Service reference. Now, one thing that I'm very keen on when it comes to making a disclosure, particularly if there hasn't been a nudge letter, is to make sure that we get the notification of intention to disclose completed as soon as possible. What we wouldn't obviously want to do is have established that there's a need to disclose, and while we're waiting to make that disclosure, we happen to receive a nudge letter, therefore turning any disclosure from a unprompted disclosure into a prompted disclosure. Once you've got the digital disclosure reference, you can go ahead and start preparing and submitting the disclosure. You've usually got 90 days from the date that HMRC acknowledge the intent to disclose to complete and submit the disclosure to HMRC. This is an online reporting requirement again. It is a pro forma essentially that you follow through, ticking which years that you need to complete and entering the income tax, the appropriate penalty and interest percentage for each year. The taxpayer is required to calculate their own tax, interest, and self-assess the appropriate penalty percentage. And we'll look at penalties in a short while. Once that's done, the disclosure needs to be submitted to HMRC for consideration, and payment of the tax is due. This is a slight change to how it used to be, particularly under the Worldwide Disclosure Facility and Let Property Campaign disclosure, prior to it being under the umbrella of the Digital Disclosure Service, in the sense that you would submit your disclosure, wait for HMRC to agree, and then the payment is due. However, now the payment is due at the same time that you make the disclosure. And that's an important distinguish, because if you don't make the payment, the disclosure will be rejected. So it's really important for taxpayers to make sure that they pay the amount within the disclosure at the time they submit the disclosure to ensure a smooth passage. Finally, once HMRC come back to you having reviewed the figures, they will either confirm that they are happy with the figures. If there are any errors, they will need to be addressed. But once we get to a point where HMRC agree the position, there will be an offer to the Commissioner's letter within the correspondence sent from HMRC. And on there, you are required essentially to confirm what you've already agreed, the amount that you intend to pay, the amount that you have already paid, because you should have already paid an amount. Obviously, these figures may be different if you happen to, if there's a difference, perhaps one of the calculations has turned out to be incorrect. And there may be a difference, but hopefully you'll have got it right first time. The offer to the commissioners will be for the sum that you calculated. And once that's submitted, HMRC will accept the offer, and that will see an end to the disclosure process. When it comes to submitting a disclosure, we at ETC like to spend a little bit of extra time ensuring that the disclosure will be accepted first time. We're seeing more and more examples of HMRC sending back errors, and it's not usually because there is an error. It's usually because the quality of the information that's provided to HMRC is not sufficient to allow the reviewer to understand how the calculations were done. So while the Digital Disclosure Service is fairly restrictive, you are able to add attachments to it. And that's one thing that we would recommend. Always take an additional time to take additional steps where possible to increase the chance of accepting the digital disclosure first time and avoid the unnecessary back and two. So we would recommend including a written explanation with the disclosure just to explain how the omission came about and what steps need to be taken to correct it. We would recommend that you prepare and submit a full analysis of the tax, the interest, and the penalty calculations. Without submitting an additional calculation, all that HMRC would see within their disclosure is the amount of tax that has been calculated. They wouldn't necessarily know how that tax had been calculated. It's therefore, I think, very important to submit an analysis so that can be checked. Make sure you meet all the deadlines set by the service. So originally, if for example, you'd received a nudge letter, you're given a date to respond by. Make sure that you do respond by that date. Once you've been given your 90-day target, again, make sure that you submit that disclosure within that 90-day window to be as compliant as possible. One thing that we also like to do is try and put ourselves into the shoes of the inspector who's going to be looking at the disclosure, and sort of preempt any questions which they might have. Almost look at the disclosure that you're about to submit from a third person perspective and see, would Joe Public understand how this was calculated? If so, it'd be fairly expected that a HMRC inspector would be able to follow the calculations and therefore pass the disclosure through without any issues. And finally, take some time to explain the penalty decision thoroughly. You'll see when we move on to penalties that the range of penalties that can be applied to a disclosure is quite wide. We obviously, as taxpayers and agents who work on taxpayers' behalf, we will always argue towards the lower end of the range. HMRC naturally will argue towards the upper end of the range. So I would always explain the penalty decision thoroughly, just so that the inspector can understand why we've gone for as low a penalty as we can. Excuse me, and to allow them to agree that position and move the disclosure to closure. So moving on to penalties and interest, as I alluded to before, there will be penalties and interest applied to a disclosure. It is obviously HMRC's prerogative to apply penalties, and you will expect that penalties will be applied, and interest, of course, backdated to the date in which the tax should have originally been paid. The rate of penalty is contingent on your behaviour and whether the disclosure was prompted or not. So just going back to what I was saying before, describing a taxpayer's behaviour and why the disclosure came about will help towards keeping the penalty as low as possible. As mentioned before as well, when completing the digital disclosure service, it's up to the taxpayer or their appointed agent to self-assess their behaviour and apply the appropriate rate. As you will be able to see there, a table of the penalty rates depending on perceived behaviour. So for a careless, unprompted disclosure, we could be looking at anywhere between 0% and 30%. For a prompted careless disclosure, 15 to 30%. If HMRC determined that your behaviour was deliberate, an unprompted disclosure would range from 20% to 70%, whereas a prompted disclosure would range from 35% to 70%. Finally, if HMRC deem your behaviour to be both deliberate and you intentionally try to conceal the information, for an unprompted disclosure, the range is 30% to 100%, whereas a prompted disclosure is 50% to 100%. These percentages relate to the PLR, the potential lost revenue. So whatever your liability is, these percentages are applied to that liability. Keeping maths simple, if you've got £1,000 liability and a 30% penalty, you will get a penalty of £300. So a careless, to be treated as careless, an error must have effectively, I suppose, easy way as described, an error is careless if a taxpayer failed to take reasonable care but did not purposefully give incorrect information. So there was no intention to give misleading information. It was essentially a case where a client has not been thorough enough in providing their information, perhaps, or that they've not taken reasonable care. For a deliberate error, HMRC have a fairly high burden of proof to suggest that you were acting deliberately. They would need to be able to demonstrate that a taxpayer knew about their obligation to correct their affairs and then chose not to comply, or that they had misled their accountant or agent by providing incorrect information. The last one, deliberate and concealed. If HMRC, first of all, they would need to prove that there was deliberate behaviour. But if you then did not, or if a taxpayer did not then take immediate action to confess the error, the deliberate action has then been concealed. Concealment can also take form in other actions, such as attempting to cover up the truth, falsifying documents, or deliberately destroying documents. In addition to the penalties table that we looked at before, where there are overseas matters, the penalty regime is considerably more severe. An offshore matter is where a potential loss of tax is charged on or relates to income arising from a source in a territory outside the UK, assets situated or held in a territory outside the UK, or activities carried on wholly or mainly in a territory outside the UK. The penalty rates for the inaccuracies I have shown on the next slide, which are here. So you will see we've got a varying degree of different rates here. For territory 1, unprompted, if it's a careless disclosure, 0 to 30. If it's deliberate, 30 to 70. And if it's deliberate and concealed, 40 to 100%. A territory 1 prompted disclosure carries penalty rates of 15 to 30% if careless, 45 to 70% if deliberate, and 60 to 100% if deliberate and concealed. Territory 2 jurisdictions, on the other hand, if unprompted, carry penalties of 0 to 45% for careless behaviour, 40% to 105% for deliberate behaviour, 55% to 150% for deliberate and concealed. For prompted disclosure within Territory 2, we're looking at 22.5% to 45%, 62.5% to 105%, and 85% to 150%. And finally, Territory 3, you can see ranges from 0 to 64 careless, all the way up to 110% to 200% for deliberate and concealed. As mentioned before, the penalties are a percentage of the potential lost revenue, and HMRC do have a list online which publishes which jurisdiction falls into a particular territory. So if you had a client, for example, who had a bank account in, say, Germany, that's likely to be a Territory 1 country. If they have an offshore account in somewhere like the Cayman Islands, I believe that is a Territory 2 or 3, not entirely sure, but you know, as European countries share more information, you know, the likelihood of being able to avoid that type of thing is slimmer, and therefore Territory 1 carries a less severe penalty. It's more likely that you would be seeking to deliberately conceal your income or gains if you had assets held within Territory 2 or 3 jurisdictions. Interest. In addition to any penalty which may be levied, a taxpayer must also calculate the appropriate amount of interest which is payable on the liability, backdated to the original due date. So, for example, if the disclosure was relating to the 2018-19 tax year, that tax should have been paid by the 31st of January 2020. The interest, therefore, would run from the 31st of January 2020 up until the date the liability is settled. There are a number of tools on HMRC online which can be used to calculate the amounts of interest due, which are fairly straightforward to use. So if you do need to use them, by all means, have a look through those. If a taxpayer is struggling to pay, they may have a liability dating back a number of years and therefore don't have the means to make that that payment. A taxpayer can request a time to pay arrangement. You will usually be required, or a taxpayer will be required to put forward a proposed payment plan to HMRC to consider. HMRC will always want the taxpayer being paid as soon as possible, naturally. And if they deem your offer to be insufficient, they may require a taxpayer to complete an income and expense analysis, in which they must report their income and outgoings to enable HMRC to assess affordability. So if your client has £2,000 or £3,000 of disposable income per month and are only making an offer of, say, £100 per month, that's probably not going to fly with HMRC in reality. HMRC will want them to be paying much more than what their original offer was, hence the income and expense analysis that they will ask the taxpayer to do. So just running through, I'd run through a little example of fairly common example of what we would see. So Mr. Jones received a nudge letter from HMRC with respect to rental income received. He's been renting out a property for the past 4 years, but has not reported this to HMRC. He didn't report the income because he was told by his accountant, apologies, he told his accountant he had rented the property, but the rent just about covered the mortgage. However, upon further investigation, his mortgage repayments were largely capital, and therefore the available mortgage interest deduction was not sufficient to cover the rental income. Mr. Jones therefore had rental profits for each year as follows, and other income of £60,000. So 6,500 for 1920, 6,850 for 2021, 9,300 for 21-22, and 10,800 for 22-23. For the purposes of keeping these calculations simple, I'm not going to include, or I've not included the tax reducer on financial costs within these calculations. Obviously, Mr. Jones is a high rate taxpayer in his own right by virtue of having other income of £60,000. For the 22-23 tax year, Mr. Jones will actually need to register for self-assessment and file a return. Providing he does this and pays the tax by the 31st of January, there'll be no penalties at interest, only the tax liability of £4,320, which is 40% of the tax due. Of the income received. For the prior years, though, Mr. Jones will need to complete a disclosure under the Digital Disclosure Service. He must register for the disclosure reference and submit a disclosure within 90 days of receiving the reference, and the tax position would be as follows. So tax due, 40%, 2,600. Penalty rate, we've gone for 15%, which is the lowest figure that we can for a careless prompted disclosure. His behaviour, I believe, would be considered careless in the fact that he hadn't taken reasonable care. Some may argue that when somebody has an advisor that they have taken reasonable care, HMRC don't consider employing an advisor as taking reasonable care. That's just their position. So on this occasion, applying a 15% penalty rate to the tax due. To calculate the interest, I've used one of HMRC's online tools for a liability of 2,600 being payable by 31st of January 21 and being paid in full by today, the 9th of November 2023. Done the same for each of the tax years. So calculated the tax due, applied a 15% penalty, and ran the interest from the relevant 31st of January up until the 9th of November 23. This results in a total liability of £11,193 of tax, interest, and penalties. So when Mr. Jones submits his disclosure, he will need to ensure that he pays that amount in full on the day the disclosure is made in order to ensure that it passes through without delay. Just going to touch on the last couple of bits in relation to disclosure outside of a digital disclosure service. So the majority, I would say, that you will come across will have a number of historic years where non-compliance has occurred. But if, for example, we're talking about a prior year where a tax return has been completed, for example, if we're working now on 23-24 returns and we need to amend 22-23, we can in fact just go back and amend the tax return as opposed to complete a disclosure for that year. The deadline for amending a tax return is the 31st of January following the submission deadline of the return in question. So for the tax returns which were prepared for 22-23, the submission deadline for those would be the 31st of January 2024, which would mean you can amend that return anytime up to the 31st of January 2025. Similarly to the disclosure service, however, interest will be due on the unpaid tax back to its original due date. So let's just suppose that an amendment was made to a return in November 2024. That tax should have been paid by the 31st of January 2024, and as a result, interest will run on that income, on that tax backdated to those dates. In addition to interest, penalties do apply within the self-assessment regime, and they are different to those within the digital disclosure service. And I've detailed them as below. So when this is, and bear in mind that this is if the liability is more than £1,000. If it's not, these penalties won't apply. But if your liability is more than £1,000 and it's more than 30 days late, there'll be a 5% penalty on the tax due. If it's 6 months late, an additional 5% of the outstanding tax at that date. And if it's 12 months late, another 5% of the tax outstanding at that date. So in the scenario of correcting in November 2024, we would be both 30 days late and 6 months late, and therefore we would expect to have a penalty or two penalties of 5% each for non-payment of that tax. Finally, there are occasions where correcting a return or a digital disclosure service disclosure is not required, and occasionally it'll transpire that an individual has received some income or made a small gain in a prior year which should have been reported but did not give rise to an additional tax liability. If the individual is not able to amend the tax return for the year in question, for example, if they have, if they're out of time, or indeed they didn't complete one in the first place, then it's recommended that a simple disclosure letter to HMRC should be submitted to place on record an acknowledgement that something has been omitted, but as there's no additional tax to pay, a digital disclosure service disclosure is not appropriate. You can only submit a digital disclosure service disclosure if there is liabilities to pay. While some might suggest to let sleeping dogs lie, particularly if there's no liability, there's no loss to the exchequer, so it's not worth doing anything. My opinion is that a short letter to disclose the information might be worthwhile, simply to avoid any unwanted HMRC scrutiny. And that's come to the end of our webinar on disclosures. Again, thank you all for attending. Are there any questions within the group?
Yes, we have a few questions, Matt.
Okay.
Because my company has a client where there has been cash sales which has been affected 2 months. However, we are unable to report accurately as the reporting system has now closed. How is this best to report for this? We are thinking of doing an average due to the missing data. It's not significant materially. Would a disclosure note in the accounts be enough?
So the company has cash sales for prior 2 months, did you say?
Which has cash sales which has affected 2 months.
But they're unable to report
Accurately as the reporting system has now closed. How is it best to report for this? And then they said we are thinking of doing an average due to the missing data. What would a disclosure note in the accounts be enough?
It's a good question. It's I'd be interested to know the quantum of the missed cash sales. You mentioned that it's not significantly, it's not a significant amount. It may be that simply a disclosure within the accounts would be sufficient. In this case, I would potentially look at writing to HMRC to simply acknowledge the missed or the omission and invite HMRC to correct that.
Okay, we have another question, sorry. My client has received a nudge letter but has already missed the deadline to respond. What should we do?
So yeah, as mentioned, if the the nudge letters will always have a date by which you need to respond, and if that's been missed, immediate action, I would suggest, is required. On the nudge letters, there is usually a phone number or an email address to contact HMRC to. So that would be my port of call. I would contact HMRC to acknowledge receipt of the nudge letter, to ensure that HMRC are aware that we've received it and that we are taking steps to respond, but that we have already missed the deadline. HMRC, I've found, are quite happy to extend that deadline if necessary, particularly if a taxpayer is appointing an advisor to assist them with their affairs. So I would just say it's important to get in touch with HMRC as soon as possible to acknowledge the nudge letter and advise that they will be responding as quickly as possible.
Another question we have had in is, how would HMRC know who to send a nudge letter for cryptocurrency, as the owners of the wallets are not known?
Yeah, so it's quite an interesting one, that, because you're quite right. The wallet addresses are simply a combination of letters and numbers usually. A lot of there are some, particularly within the decentralized the DeFi zone of crypto, where there are no ID checks required. So in those cases, it's likely that HMRC will never be able to get that information. That doesn't necessarily mean that if you have gains within in a MetaMask wallet, for example, that you shouldn't report them, because ultimately it's a taxpayer's responsibility to report them. For exchanges such as Binance and Coinbase and KuCoin and Bybit, I think they'll all require individuals to carry out KYC information. So this information has been shared with HMRC. So HMRC will have a record of the person's name and what their various wallet addresses, and they'll be able to get that information. So it'll be from those types of exchanges that would likely generate a nudge letter. But as mentioned before, just because you have one that's not on one of those exchanges does not mean you should not disclose if you have income and gains.
Okay, another question is, if I amend a client's prior year's return, does that affect the inquiry window?
Yes, is the answer, short answer. Excuse me. So if you submit a tax return, HMRC have 12 months from the date that you submit that return to open an inquiry into their affairs. If you submit an amended tax return, HMRC have until the following January. So to give you an example, for the 2022 3-year, for example, let's suppose you submitted that return on the 17th of May 2023. HMRC would have until the 16th of May 2024 to inquire into that return. If, however, you did amend that return, HMRC then have right up until January 2025 to open an inquiry. So it does extend the inquiry window, yes.
And how far back does the DDS go, and is there a time limit on making a disclosure?
The Digital Disclosure Service does go back, I think, about as far as 2004, I think. It's been a while since I've had one go back that far, to be quite honest. However, it's important to note that a disclosure should be made for years going back that far, but it might actually be that HMRC cannot recover the tax for years earlier than, well, more than 6 years back. If HMRC haven't opened an inquiry or anything into any of the prior years, HMRC can only go back 6 years unless they believe you've effectively deliberately defrauded the system, in which case they can go back 20 years. So it might actually be a case where you declare 15 years worth of liabilities, but only actually have to pay the tax for the past 6 years with interest and penalties. You can choose to pay the additional tax if you wish. It's called a voluntary restitution. And I suppose that's down to a taxpayer's good conscience as to whether they wish to do that or not.
Okay, another question is, a client failed to make the return within 60 days on sale of a residential property. has reported gain subsequently in tax return. Is this sufficient, or do you need to still make the residential property return for the gain?
This is quite an interesting one because the rules actually changed on this one when it was originally when it was when the new system came into there was it was described that if you had already submitted the tax return, then a 60-day return is not required. However, HMRC changed the rules on that because the only way in which they can apply the penalties for non-compliance of the CGT return is by completing a CGT return. So even if you've already submitted a tax return for the disposal of the residential property, unfortunately, the taxpayer is still required to submit that 60-day CGT return.
Oh, and finally, what did you mean with regards to suspending penalties, and what is the likelihood a client can apply a 0% penalty?
So penalty suspension is usually where HMRC have applied a penalty rate, let's call it 10%. But because if this is a taxpayer's first discretion and sorry, indiscretion, and they've taken steps to correct as quickly as possible and make representations that they will take additional steps to ensure that non-compliance doesn't happen again. On occasions, HMRC will agree to suspend the penalties pending good future behaviour. So what that basically means is you agree that you will ensure that your tax affairs are up to date for a period going into the future, providing you do that and are able to do that, then HMRC will not enforce the payment of those penalties. As for the 0% rate, it would have to be a pretty prompt disclosure shortly sort of after the time limits of say amending a return to qualify for 0%. It's I suppose we would always apply the lowest percentage that we can get away with. HMRC are almost certainly not likely to apply a 0% penalty, except for very unusual circumstances. So in any case, I would suggest that a penalty is applied, but as I say, if it's the client's first indiscretion and they put forward representations to ensure that they don't transgress again in the near future, then HMRC may agree to suspend the penalties. It is entirely at HMRC's discretion, though.
Brilliant. Thank you, Matt, for an informative webinar. Please do get in touch if you have any more questions. If you'd like to follow us on LinkedIn and Eventbrite, and look out for our next webinar, which is Tax Hot Topics on the 7th of December. Look, yeah, keep your eyes peeled for the early bird offer as well. But like I said, please do get in touch if you have any further questions. Thank you so much.
Just a last one. Here's my information for anybody who wishes to get in touch. It's my email there and direct phone number. If you've got any questions following this webinar, I will be more than happy to see to those queries. So thank you once again for coming along. I hope as a first attempt, this webinar was good for everybody. I would appreciate any feedback that you wish to give, good or bad. Would be much appreciated. So yeah, thank you again for coming along, and enjoy the rest of your Thursday. Take care.